All right, guys. So thanks everyone for attending. Today's webinar is not another crypto tax webinar. Today I'm going to be presenting on behalf of Fullstack and along with Koinly, who Danny will be representing. He's also the head of tax. So getting into it, before we do, just a quick legal disclaimer. The contents of today's presentation doesn't constitute specific legal or tax advice pertaining to your affairs. Today's content is also based on current legislation and guidance from the ATO and is obviously subject to change. Being in crypto changes quite rapid, so just be very wary for listeners who are rewatching this session today. We always encourage those attending and interested to reach out to us where we can advise on how the laws apply to your specific situations. So a bit about myself. So I'm a tax manager here at Fullstack Advisory. I oversee the crypto tax team. I love all things tech, and I try to incorporate a nice working environment for the team. We all have very similar interests and we get along very well, and we're all here with vested interest in seeing you succeed. But Fullstack as a firm, we're an award-winning accounting and advisory firm catering for the financial needs of innovative businesses. Our team of professionals deliver affordable and effective solutions across accounting, tax, financial modeling, VCFO services, and R&D tax incentives. There's probably some more in there that I missed, so if there's anything else applicable, please reach out to us. But we work with innovative businesses, particularly the Web3 and blockchain technology space. And as a result of that, our service offerings has naturally evolved to include crypto. And since then, we've become one of the largest providers of professional services in this space. Fullstack does pride itself on having a vested interest in the community, the crypto community, and we do work tirelessly in assisting the community with the intention of seeing this space thrive. So we have here Danny, who's head of tax at Koinly. Danny, would you like to give us a bit of a spiel on yourself and also Koinly?
Yeah, sure. Hi, everyone. Danny Talwar, head of tax at Koinly. I'm a keen crypto enthusiast myself. I spent a lot of time in international tax space, so I do have a tax background. And at Koinly, really just helping at the moment, focusing on the Board of Tax Review, which is an ongoing consultation. Really keen to see the recommendations that come out from industry on that. And Koinly, as a lot of you will know, is a software tool that allows you to bring together your portfolio from exchanges, digital wallets, and track that firstly in one place, but then also to generate a tax report, which accountants like Fullstack can use when helping their clients who hold crypto.
All right, so for today's agenda, we're going to be discussing the current tax environment in crypto, the record-keeping requirements, how to comply with these record-keeping requirements, also understanding the tax implications of your affairs is very important. Determining if you're investing or trading, there's been some changes there, which is quite interesting. Also diving into the tax implications for other crypto activities as well, including staking, liquidity pools, DeFi, receiving airdrops, mining crypto, and NFTs. Also touching on how to deal with capital losses and avoiding loss sale arrangements, which might be quite more common than what we probably think. And a quick overview of some tax structuring options which are available. The tax implications of these entities, and also the ongoing services and administration of these new entities as well, which is very important to understand. We don't just go through the process of setting something up, not knowing what to do next. So it's quite a bit involved, so important to touch on those as well. So looking at the current state of the tax environment for crypto, so to absolutely nobody's surprise, whatsoever, the ATO has announced once again its focus on crypto. The ATO has recently revised their take on crypto, and the crypto will be seen by the ATO as mainly a capital asset. So previously there was room left for interpretation as to what constitutes an investor whose crypto is treated on a capital account compared to a trader whose crypto affairs are treated on a revenue account. So the ATO has finally identified this issue and has painted a very clear picture as to which is which. We will discuss the details of the practical implications of this later in today's presentation. But the ATO continuously allocates a lot of resources in providing as much guidance as possible, which in some instances has previously lacked with regards to crypto tax affairs. So with the revised guidance, it appears that the ATO is taking a more simpler approach, where many crypto tax affairs will be treated on capital account. The ATO has facilitated a welcoming step forward in this regard, which helps to deal with the complexity of crypto tax and should result in less confusion and more concise reporting on crypto tax affairs, which is nice. These are all very recent, like June and August recent. So what about the ATO? So the ATO continuously stresses the importance of maintaining adequate records. So their imposed record-keeping requirements for crypto asset transactions include the date of the transaction, the market value in Australian dollars, and also the purpose of the transaction. There's any third parties and things like that as well. So taxpayers importantly need to keep records for up to 5 years from the later of when the records were prepared, when transactions were completed, or when the CGT event occurs. So many taxpayers have historically kept really poor records of their crypto activities and have relied solely on exchange data or the data being available on the blockchain to be accessed when required. So really the practicalities of this is over time people forget. Also over time, people's affairs become more complex and harder to ascertain transaction details, as data may be difficult to collate or access, might not even be able to access it whatsoever. So in saying that though, we are seeing a trend of better record keeping across the board, which is very welcoming. So it's not all grim. Over to you, Danny.
Yeah, sure. So I think from an accountant's perspective, it's probably just important to cover what record keeping requirements in relation to crypto asset holders are relevant. So the ATO obviously require you to keep records of all capital gains, losses, income or revenue account, or ordinary income in tax return. But the lines get blurred when people trade with crypto, because often it can be really hard to track, and certain protocols do not always generate easy tax reporting information to help keep the records that the ATO need. And so I think there's a balance there between ensuring that accountants are compliant with the Tax Agent Services Act and take reasonable care to actually determine what the client's tax obligations are. Now, software is very common. So the use of software reporting, software like Koinly is helpful in bringing that data to the accountant, but it's still really important that the accountant takes full responsibility and undertakes their due diligence in relation to those affairs. And ultimately, software is only going to be as good as what you plug into it. So, if your client leaves a wallet out, for example, and doesn't connect all their wallets into Koinly, then that's not going to give the correct outcomes or calculations. So I think it's really important, obviously just have a checklist before engaging with clients that may hold crypto. Firstly, to ask the question upfront, do you hold crypto? And I would even suggest just having a checklist that allows you to determine the level of complexity that the individual holds in relation to these, in relation to their crypto. So, they might just be buying and holding, in which case, their tax obligations are likely to be very simple. But if they're involved in gaming activities, trading NFTs, believe that they might be running a business, have very, very high volumes of transactions, that is a kind of flag to the accountants to say, well, there might be some more involved work needed here. And ultimately, that just helps from a pricing perspective as well, just making sure that everyone can recover costs involved, because I've heard so many stories from accountants around just fees blowing out of proportion and clients unwilling to pay and not appreciating the work that gets done on the back end. And a lot of that conversation can be had upfront through checklists and just information gathering at the start. And again, software record records should be kept for 5 years after tax return filing, but the ATO do have powers to extend beyond that, where individuals may be deliberately concealing statements. So this is actually just is specifically what the ATO actually say to keep records off. So the date of the transaction, so when you've purchased it, when you've actually made a taxable disposal. So there's a lot of disposal events that you can incur through trading crypto. Often people won't realize that they're actually incurring these disposal events. And so, when you actually transfer crypto to crypto, for example, at that point, you need to record the price at which you transfer asset A to, and then the price at which you acquire asset B as two separate points there. The value of crypto asset obviously needs to be recorded in Australian dollars. There are complexities that can arise for individuals that hold stable coins, which are digital tokens backed to fiat currencies like US dollars, but also if they're trading in US dollars or in foreign exchanges. So I think what's also really important, and this will probably come out through the presentation, is intentions are really important to understand from clients. It's not just, what they're transacting with and when, but also why. And this goes a lot to the correct tax treatment that applies, because, whilst it's important to determine investor versus trader, those lines get very blurred very quickly with crypto trading. Often people trade huge volumes. If someone's playing an in-game application that allows them to trade multiple times just by playing the game, that's often taxable events that get triggered with someone that's completely unaware. And so what's really important is to understand intentions in undertaking these crypto activities in the first place. And so I always suggest, when you do have a transaction or you're going through a client with a number of transactions, is actually to ask that question, what are you seeking to achieve? Is there a profit making intention there? Are they trying to understand how a protocol works for educational purposes? Is it genuinely something for personal use? I mean, it's really hard to fall within that personal use bucket per the ATO guidance, but nevertheless something to consider. I thought I'd also just draw attention to something that's quite handy you can do in software, which is just add a description. So this screenshot on the right is just a screenshot from an edit transaction button that you can do in Koinly, and it just allows you to add in the description there what that transaction was. And so I just thought that's obviously good practice to get into and to get your clients to do that as well. And so documenting those notes, I think, goes a long way to keeping proper records.
So basic items to tick off, sometimes the most tedious as well when we're looking on how to comply with record keeping obligations is, data transactions, like we mentioned, value of transactions in Australian dollars, etc. Can be dealt with coin tracking software. So using a coin tracking software should not just be like an annual task that's undertaken. It's really something that can be used to your advantage in providing useful information regarding your asset portfolio, which may aid in effective investment decisions. Understanding that the software there exists where you're amalgamating all your data from multiple sources, wallets and exchanges, all essentially in one spot. So you're ticking multiple boxes. And getting the value out of that, I think, is quite important to understand unrealized positions and things like that, to understand, to aid in those investment decisions that are being made. Like we've already discussed, it's imperative that records are kept also with ascertaining ownership, so the ATO doesn't identify, necessarily the wallet owner as the underlying owner of the assets contained within the wallet. We often see spousal relationships where assets are held together. They could be 50-50 and so on, or on either rule's behalf, where someone in the relationship might just be providing the capital and the other person is investing it. We also see taxpayers invest with other family members' funds as well, siblings, aunties, uncles, things like that, even friends. So where that's the case, it's really important to clearly document that ownership and if there's any particular arrangement like that in place, right? Because really the tax implications follow those people who actually own the asset And whoever's driving the exchange account or the wallet is basically just operating off of the directive from the individuals who have provided the funds for them to invest on. So using something even like an Excel spreadsheet, something simple where you can just name all the exchanges and wallets that have been used and advise what they're being used for, who owns them, and so forth, I think is a really handy strategy to have. Saves a lot of grief come tax time. And doing it as you go along, it's like keeping receipts, right? So you're not going on a mad hunt trying to find receipts at the end of the financial year. You're keeping a folder or shoebox sort of approach as you go along, so everything's there and handy.
And I might just jump in there because it's quite topical at the moment, given a few protocols have collapsed and a lot of people have lost funds. Being able to claim a capital loss relies on being able to actually demonstrate that you've incurred a loss and you are in ownership of the assets prior to them being lost. So
Absolutely.
having this in place is important from that perspective as well, when you might need to claim a capital loss down the line.
Absolutely, yeah, for sure. So yeah, documenting the intention and purpose of each transaction. If you're not just buying and selling, you might be gifting assets like we've sort of alluded to before, buying assets which have been sold at losses. The ATO can actually, we'll speak about watch sale arrangements in a little bit more detail further in the presentation, but the ATO can actually deny that capital loss if they deem a watch sale arrangement to have transpired. So it's crucial to remain, compliant in that regard when we're keeping clear records, but also to assist in the understanding of what's actually transpired in that financial year come tax time. So understanding the tax implications of your affairs, pretty important stuff. So whether or not, you're passively investing, dollar cost averaging, trading, buying crypto, etc., using a Visa card, to use your crypto to acquire goods and services, pay for groceries, etc., which can now be done. There's a lot of different tax implications to understand here. And also as well, we often receive queries regarding what the taxing points are for particular crypto transactions. And another thing as well that we're often asked is, well, what does the ATO know about this? Like, does the ATO know if I hold this wallet? Do they have data matching capabilities with this specific source or this wallet or this exchange? Because essentially you set up a wallet, you don't KYC yourself. It's basically unknown, right? But it's important to understand as well that for the income tax system that we have is self-reporting. So we have laws and guidelines to follow in order to accurately report our affairs and do so honestly. So in understanding this, the question is not, as to whether or not the ATO knows, is really irrelevant, right? With so many activities undertaking crypto, it's crucial to understand the tax outcomes, ideally before we start investing in a particular activity. So now we'll talk about determining if you're investing or trading. So this is some welcoming changes here. So with the ATO's recent change to crypto investing and trading guidelines, it's now more easily and practical application than ever before to ascertain that position. So basically, the ATO has taken a sort of a blanket approach that all crypto is basically capital in nature, and that's irrespective of number of transactions, which there was a bit of conflicting opinions as to whether or not that was the case before, looking at volume of transactions, repetition of activities, and so forth, even the amount of capital that's being invested. But now the blanket approach is basically from the ATO that everyone is treated as an investor unless there is a specific undertaking of a business activity or taking appropriate steps in carrying on a business. So the ATO has emphasised these as undertaking your affairs in a planned, organised and carried out in a business-like manner. So business-like manner, it basically includes, registering a business name, setting up an ABN, can be repeating similar activities. The size and scale will be consistent with other similar businesses. Whether or not there's a degree of business records that are being kept, going through the process of setting up a different bank account specifically for the business, or having a dedicated business premises or location where the activity is being undertaken. These are all now factors to take into consideration when we're trying to determine if someone's trading. And if we're not ticking any of these boxes, it doesn't, the ATO is basically saying it doesn't matter if you have 1 million transactions, that doesn't necessarily constitute as being a trader, which is quite a good outcome from trying to ascertain that position perspective. So, you know, with investing and trading, what are the tax implications? So investing, it's all on capital account. So basically, there's no real tax implications until you actually sell something. And selling can be swapping it for another crypto. It could be basically if the underlying ownership has changed, but that's basically the point of where the CGT event will occur. So even if you're transferring it to it can be when you're transferring it to a related entity, if you're transferring it to a spouse. It's important that, like, if you know, you can't necessarily just gift an asset. If the underlying ownership has changed, then it typically triggers a capital gain event. And under the capital gain provisions for individuals, we can access a 50% discount if the asset's held for 12 months or longer, which is fantastic. And then trading is basically treated as a business. So imagine a business is profit and loss. It's very much akin to that. So whenever you sell something, whenever you swap something, whenever the underlying ownership changes, it's not treated as a capital gain, it's actually treated as a sale. And the sale is the market value of the transaction. We also recognize any acquisitions of crypto, which could be through swaps and the like, as purchases. It's also important to note as well that the main things really are the trading stock provisions will apply, which will require us to value the opening and closing stock. So this is basically done at every single, you know, at the end of every single financial year with the portfolio, with the closing portfolio rolling over to the subsequent year as the opening portfolio. And importantly there as well, that the closing portfolio valuation actually attributes towards the taxable income. It increases the overall profit of the business activity, whereas the opening portfolio is actually claimed as a deduction. So some of the other crypto activities, so looking at staking, still a very popular investment option in crypto. Hodlers can, you know, lock up their coins or tokens in order to generate interest or rewards, which is great. There are some shortcomings with staking. We've seen a lot of these in recent times where the market's not performing as well, which include, you know, receiving interest or rewards when prices are high, and then, you know, selling them when they're low, right? So the two, it's important to note that the two will not offset each other, because one, the income or the interest that's being generated is treated on a revenue account, and then actually disposing of that asset is treated on a capital account. So a little bit of an unfair sort of treatment there, but in my opinion, but yeah, I don't know of any remedy at the moment where that is treated any differently, but that's pretty clear in the guidelines. So
the staking concept is something that's actually been kind of hashed out amongst many as part of this board of tax review. So essentially, with the board due to report to government on their findings to inform tax policy of future around digital assets, staking comes up as an area with a lot of uncertainty, and you know, it's important to recognize that there's different types of staking. You know, in the traditional sense, you know, you can actually stake direct onto the particular blockchain. Often that requires quite high barriers to entry. So for example, if you wanted to stake Ethereum directly and run a node, you need, I think, 32 ETH, which is a lot of money. And so as a workaround to that, individuals can actually participate in staking pools where a centralized entity might run a staking pool on individuals' behalf, collect that cash, and then pay out staking rewards to each individual person that's contributed. There's also decentralized finance alternatives as well that actually allow you to stake. And so there's at the moment when you do provide funds to staking, there's a question as to whether you change beneficial ownership by virtue of contributing to certain staking pools, often you get a token in return. And I can see liquidity pools is on here as well. So it's important to know that there is some complexity here, even though the general concept of staking income being treated on revenue account versus capital account is generally accepted. There's kind of nuances there that make that treatment more complicated. I'll just call out one that's interesting is just around timing. So, there's certain protocols that you can stake with where you can actually click to draw down funds that have accrued over time. And so the question there is, do you trigger that taxable event when you actually click and draw down your rewards, or when it first shows up in your account? And those types of timing issues are also ones that cause a lot of uncertainty.
That's a very, very common issue that we also see is when is the actual income from that particular activity derived? Is it derived when it's earned on the network and you need to go in and claim it? Or is it at the point where it's actually claimed? Because in some of these DeFi platforms, well, pretty much most of them, they don't actually enter the blockchain as a transaction until the owner physically goes in there and claims or ends that stake or claims that reward. So the deprivation of income becomes a significant issue there, because it basically allows the choice of timing as to when it hits the blockchain, which could be for better or for worse. So the spirit of the law is basically revolved around, when is the actual income earned as when it's derived, and claiming it at a later date is basically, and subsequently reporting that as income at that date would be, there's a disconnect there between when it was actually earned. So that's quite a big challenge for legislators to actually combat that. But yeah, like you see there for liquidity pools and DeFi, it's an area of law that's the ATO's failed to provide a significant amount of clear guidance as to the tax implications. I mean, in the ATO's defense, they have been active on their community forum page with attending to queries from the public with regards to this specific issue. But some of the responses, I think, have shown a fundamental lack of understanding of how the actual technology and protocols work. And it's also important to note as well that DeFi platforms, they might operate in similar ways, but they can also be, they might have some significant key different characteristics of how they operate and how income and rewards are being earned by the provider of liquidity as well. So it's an area where you definitely need to seek some professional advice. The ATO's recommendation is to basically apply for a private binding ruling, and if that's the case, then be prepared to wait, because historically they haven't been fantastic with their turnaround times, and rightfully so, because these issues are quite rampant at the moment. So liquidity pools, DeFi, that sort of aspect can be a bit of a void. So it's always important to discuss that in detail to identify what the actual implications are. And before I move forward, so airdrops as well, receiving airdrops, it's basically treated in the exact same way as staking. So you receive an airdrop, there's a coin or token which is deposited directly into a wallet or an exchange account. And what happens there from a tax perspective is that it's basically treated as income. The point of it being earned, air quotes earned, because it's unsolicited, is basically the same point that's deposited into the account. So at that point, it's treated as income. And then what happens is, if you dispose of it later on, then that treatment or that gain or loss is treated on a capital account. So it's the same sort of issue that they're staking. So if there's a disconnect in the prices between the disposal value, where that value is less than the value of the coin or token when it was received, there's going to be a capital loss. And the capital loss will not offset the income that is being reported as well.
I think it's just worth noting that it went kind of under the radar a little bit. Last week, the ATO actually updated their guidance on airdrops, and they now distinguish between two types of airdrops. So airdrops generally are used as a marketing tool, and often if you interact with a protocol and the protocol they use wants to develop tokens or expand their kind of offerings, they might actually airdrop token holders or people that have just interacted with their protocol in the past. And so they're kind of gifts, as John says, that unsolicited, often uses marketing tools. Now the ATO's change is basically differentiated the initial allocation airdrops. So if you get airdropped something that's the first of its kind, then at that point they won't tax as ordinary income at market value. They will just have no ordinary income when received and zero cost basis. So you do still have to pay. Still have to consider your capital gain obligations when you sell the asset. I think that's quite a helpful revision in their guidance. It still calls into question, what is an initial allocation airdrop? There's a few examples that a lot of people have provided, like ENS domain names from the Ethereum network. It could lead to amended returns because the guidance was only updated last week, but it's just something to note, I think.
Yeah, it's a good example of where the ATO is trying to paint like clearer pictures as to how like distinguishing between affairs and providing some clear guidance is definitely the ATO's goal here. Is at the end of the day, they want a reporting framework in Australia where crypto taxes is void of ambiguities and things like that. So I think that's very important that they're taking, and it's welcoming news as well that they're taking that approach. But sometimes, like I mentioned or alluded to, it does pose more questions than answers in some respect. So there's always going to be that sort of grey area where there's a particular project or coin or token that's doing things, or platform that's doing things slightly differently, and it's all part of the innovative space, right? That crypto and Web3 sort of operate in, and blockchain technology. So it's interesting times. I think the ATO is sort of chasing the tail a little bit. It's interesting, but definitely welcoming. So some other activities as well. So looking at mining. So mining can be treated as capital or on revenue account. Again, this sort of it all depends on how your affairs are being conducted and if they're being conducted in the ordinary means of carrying on a business. So crypto that is mined will either be a capital asset, and the cost base of the asset will equal the value of the crypto when it's mined, or it will be treated as trading stock, right? So like traders, you've got to report the opening and closing stock portfolio valuations. It can also mean more deductions are allowed as well if you're carrying on a business, because typically in those situations, general deduction rules will apply. For NFTs, so non-fungible tokens, still dominating the sort of innovative blockchain space. A lot of unique applications being regularly seen. Always hearing about some interesting things that some projects are doing things slightly different. Everyone's just trying to outcompete everyone else by doing things differently, which is fantastic. It's definitely creating a very creative, competitive sort of market, and very interesting to see. So, from what I can see, it's definitely flourishing. But it's important to understand that NFTs are basically treated the exact same way for income tax purposes as other crypto coins or tokens. The ATO hasn't distinguished them any differently from an income tax perspective, but they have done so for from a GST Act perspective. So if you're one of the businesses that are carrying on the business of creating NFTs, the platforms, and all those sort of things, then NFTs may attract GST. So it's very important to seek advice regarding that, especially when it's such a massive consideration. For NFTs, though, for the regular investors and traders, basically it will be treated on revenue or capital account as either or, respectively. So, like we mentioned before, dealing with capital losses and avoiding a wash sale arrangement. So, what is a wash sale arrangement? So basically, the ATO has defined a wash sale arrangement as selling an asset to realize a capital loss only to buy it immediately back. So there was some tax guidance on this, or a tax ruling on this in 2008, where the ATO basically said that if there's no change in economic exposure or interest in the particular underlying asset, then the capital loss can actually be denied from being applied against other capital gains or doesn't deny the capital gains event from occurring, just denies the application of the loss. And this might be very common, more common than what we might think. So I like the example of disposing of an asset like Ethereum at a loss and acquiring it back immediately, because you might be using that Ethereum for another token on the same network that you were seeking to acquire. So on one hand, you're selling it, you buy it back, and then you swap that for something else is essentially the example. So although the amount of Ethereum sold at a loss and then acquired back might be different, it may still appear just by looking at the transactions without any context whatsoever, that transaction was entered into for the benefit of seeking a capital loss. So we can see the trend here that it's imperative that adequate records are kept and clear documentation of the intent and purpose behind the transaction is kept. So if the ATO probes around, we've got clear documentation to say that I entered into this transaction for X, Y, or Z reason. That's imperative. So overview of some tax structuring options which are available. So this is another very common query which we receive is, how can we do things more tax effectively? So tax structuring becomes a prominent issue where ordinary incomes are obviously quite high, or if the degree of crypto activity is yielding a significant amount of return, because they sort of go hand in hand. The correct structure can really save thousands, tens, hundreds of thousands in extreme situations. The correct structure is also viable when you're undertaking different types of activity within crypto. You could be mining, dollar cost averaging, gradually acquiring a portfolio over a period of time, or actively trading and so on. So, for example, utilizing a trust, typically done for more long-term holds, if someone's hodling, dollar cost averaging, etc. While a company can be used for more short-term holding positions or more business-like activities. Companies are also, best utilized where there's no capital gains and the taxable income is, over 150, 200,000. It's also important to understand as well that structuring does require careful consideration for personal situations. There are external factors. What are the goals? Do you have a particular plan in mind? All these things can influence whether or not a particular structuring option is viable for you in your situation. It's fine to say that trusts are good for X reason and companies are good for another reason, but without consideration for a holistic understanding of your affairs, it's quite difficult to provide a solution. So we do offer in-depth analysis in that regards to understand your situation in detail, and then provide a solution or further correct structures which can be used for your affairs. So if you'd like to know more about structuring options, which I think are fantastic, it's probably one of the simplest way of deriving value with your portfolio, but there's quite a bit to it which we'll discuss in detail. So tax implications of operating a trust. So the trust itself is not recognized as a separate legal entity. It doesn't get assessed for tax purposes. We still have to prepare a lodge tax return, but the taxable income of the trust is instead assessed by the beneficiaries of the trust. So the trust won't pay any tax. If there's no beneficiaries of the trust, then the trustee will be assessed at a penalty rate. That sort of rarely happens, but it's there, it was there. The taxable income from the trust will flow through to the beneficiaries, and will add the distribution, where the beneficiaries will basically add the distribution from the trust towards their overall taxable income. So if the taxable income flowing through to an individual beneficiary includes capital gains, which we like to see that is the case, that's what we sort of like to plan for. And if the gains are eligible for a 50% discount, then it will be actually accessed at the individual level. So again, the CGT discount will be applied if the income or the gain is treated on capital account, and if the asset was held for more than 12 months or longer. So if the trust has taxable income, which includes capital gains, that can be discounted. If the recipient of the trust distribution is a company, the company will not be eligible for in applying the discount. It's only available for individuals. So it's also important to note that the trust simply just holds assets on behalf of beneficiaries of the trust, where the trustee of the trust directs the assets to achieve that purpose. So I've got a nice little example here of the tax benefits of having a trust. We've got here Vince. Vince was lucky enough to invest in some Bitcoin, or this in terms of Bitcoin in early 17. So it looks like he acquired about 25 BTC for about $2,000 AUD each. Vince later decided to sell 10 of his Bitcoin in September of this month, at a price of about $30,000 AUD per Bitcoin. So assuming there's no fees, keeping everything very simple, we understand that everyone's situations are, unique, and we're making some basic assumptions here, but just for illustrative purposes, we're assuming absolute nil fees, costs, etc. And there's just an overall gain which has been made on the BTC that's been disclosed of about 280,000. With the CGT discount, Vince is because he's an individual and he's held the asset for much more than 12 months. And without any other taxable income, Vince will report taxable income of 140,000. So with the income tax liability and Medicare levy Medicare levy on that, we're looking at about $40,000. On the other hand, on an alternate universe, Vince actually had a family trust, right? And the exact same scenario. So he acquired the BTC, he sold 10, has resulted in the same amount of a gain. So it's important to note that the trust can actually benefit, or the beneficiary of the trust, if they're individuals, can actually benefit from the discount as well. So in a trust, the benefit there is that you can distribute the same income to multiple beneficiaries of the trust, where you're effectively taking advantage of more than one individual's marginal tax rate. So Vince has a spouse and an adult child who he would like to distribute income from the trust to, where neither of them work. So each of the three will receive an even portion of the distribution, including the cash. All right, there's we're doing things correctly here. So especially for the adult child beneficiary, we're actually distributing the cash economic benefit of the distribution. So we're ticking all the boxes there, or most of them. So they're all going to report taxable income of approximately $93,000. That gets discounted at the individual level to $46,500. And that's what will be reported as their final taxable income for the year, because we're assuming no other income. So the income tax approximately on that is about $6,500. If we add that all up, times by 3, it brings it down to $19,500. So the trust in this situation, actually, Vince would benefit by having an additional $20,000 in his back pocket, free to use as he likes. And this will derive from the fact that he's had the trust and is able to strategically distribute income from the trust in a tax-effective manner, and resulting in a much lower tax liability at the end of the year. So, tax implications of operating a company. So, companies in Australia will incur a flat corporate tax rate of 30%. Unless the company is a base rate entity, then the corporate tax rate will be lowered to 25%. A company that's solely just trading in crypto assets, it's unlikely that it will be a base rate entity, and therefore it's also likely that the corporate tax rate of 30% will apply. Companies, what happens with the company is the company will pay its own tax, and there's multiple different ways where we can access funds from the company. We can pay out a wage, we can declare a dividend and pay that out, or we can take drawings. So it's important to note that drawing funds from the company may provoke the provisions of Division 7A, which requires the money basically be paid back over a period of time, and interest is also charged at the ATO's benchmark interest rate. There are other implications there as well. So the administration of companies in this respect is a little bit more involved. There's a little bit more red tape which needs to be considered and discussed. And going around the block a few times, having a company with, going through a few financial years, earning a few stripes, it tends to help a lot in understanding how that all operates. Again, it's also important to note that the company will not benefit from the CGT 50% discount, only available to individuals, so not going to happen. Moving on. Got another example here, Patrick. Patrick is a sole trader. he's a sole crypto trader. Tongue twister there you go. He undertakes his affairs in a business-like manner. We're ticking all the boxes as to what the ATO now constitutes as a business. You know, he's set up a business, he's got his own bank account, and he does operate his affairs on a full-time basis. Patrick successfully traded in the 2022 financial year, and he had earned $250,000 in profit. So this is inclusive of absolutely everything, and this is what he will report as his overall taxable income for the year. Now, in reporting that taxable income as an individual, he will incur an approximate tax liability of $88,000. Now, again, sort of alternate universe, Patrick actually had a company this time. The smarter Patrick had a company for his particular affair. The exact same affairs and activities were undertaken. And basically what will happen is, because the company's taxed at the flat rate of 30%, which is significantly less than the majority of the income that's been derived by Patrick at an individual level, incurring tax in excess of 45%, including Medicare levy, resulted in a tax liability of $75,000. So that presented a tax savings of $13,000. The company may also incur some additional tax savings depending on how the dividends are paid out as well. All right, so very important. Sometimes you will have shareholders of companies who are trusts, where the dividends are paid to the trust and then the trust can distribute, or you might have multiple, ordinary shareholders where income can be effectively distributed through dividends, and that means to lower that overall tax amount, because the tax that's paid by the company is credited as if a fully franked dividend is paid out. So very important to take note of that. Okay, so the ongoing services and administration of new entities. There's a lot here. So setting up your new entities or your new structures to protect your assets and to provide the tax saving opportunities can include a lot of additional administration. This can include, setting up new bank accounts, exchange accounts, hot or cold storage wallets, transferring assets, and a lot more. So typically going through a few tax periods, like I mentioned before, will help you get accustomed with the right guidance and ongoing advisory services as well. However, some additional services in this regard are also incorporated. They can include ongoing traditional bookkeeping services, such as bookkeeping in Xero or another accounting software, crypto bookkeeping, preparation of financial statements and tax returns. It may also include the preparation of the BAS, where you need to report your GST or wages which are being paid, and reporting the pay-as-you-go withholding and any other taxes that are applicable. So, typically it requires year-end tax planning as well, and sometimes, like I mentioned, the ongoing advisory. So you want to tick all the boxes, make sure that the ATO is happy, but you also want to be making sure that you're getting the correct value and advice out of your structure, as was the intention in the first place. So we have had clients engage with us that have already had their entities set up years ago, thinking that it's as simple as saying that you have a trust or a company, and the trust or the company carries on investment activities, and it's just automatically being done in those new entities. There's actually a particular process of transferring assets and things like that that needs to actually be undertaken in order for that to be the case. So a bit of misconception with regards to this, where we pride ourselves in providing as much thorough advice as possible to ensure that you have as much insight into your affairs and what you're getting into and how it all works, etc. And we try to position ourselves as a bit of a partner, like a business partner in that regard as well, to provide the assistance. All right, so if you have any queries or concerns, please feel free to contact us. You can contact us for a confidential free consultation if you don't feel comfortable leaving a question in the Q&A section. We can have a free consult, complimentary, have a very quick review of your affairs and discuss with you the associated implications with regards to your affairs. We also offer more detailed tax advice as well, which may be required, but we can have an initial chat about that first before we make any recommendations and identify all the situation for you. And also, lastly, Fullstack can assist you in remaining compliant with ATO, of course, ensuring that we're ticking all the boxes, but also incorporating best practices in your affairs to achieve, the best possible outcome. All right, thanks, guys. Well, that concludes today's content delivery for our presentation today. Let's jump over to.
I know there's a question. I was just saying that there's a question in the Q&A section.
All right, let's have a look at this. Could airdrops be considered as a gift within the $10,000 threshold? That is.
So my understanding is the ATO's base position will be the revenue treatment if it's not an initial allocation airdrop.
Yeah.
The $10,000 threshold generally applies to personal use assets. So I generally wouldn't have thought that, to have a gift, you have to really be able to understand, well, how has the gift actually been construed as an airdrop? Because I think they're two very different events, if you like.
Yeah, it's I'd have to agree with that. Probably revenue treatment is the way to go there. It's I mean, those sort of things happen, and like the whole issue with personal use assets is quite a hard sale to make into proving that the asset is genuinely personal use. Typically, when we see clients looking to argue that something's personal use, typically comes from a significant involvement in crypto, investing, trading, and so forth. So the foundation's already there that individual is engaged with crypto with a profit-making intention, or to slowly acquire wealth over a period of time and gain from and benefit from the gain that they've made. So to have someone, which is basically almost every single inquiry that I've received with regard to the specific situation, it's likely that it's not going to be personal use whatsoever. So airdrops, it's I mean, it's kind of sucks really, because it's completely unsolicited. Some people are aware of it. So airdrops are quite common in the NFT space. They're quite some NFT projects are quite vocal about the benefit of holding a particular NFT and the airdrops associated to that. Whereas in some other instances, it's just a marketing sort of pitch, or a sort of platform goes live and there is airdrops that are associated to early investors or adopters of the Koinly token. Did anyone have any other queries or anything like that you'd like either me or Danny or collectively address? Thank you, Jenny, for that one though. That's a good one. All right. Not too sure how much longer you'd like to leave the floor open, Megan, but if there's no other queries or anything like that coming through, I think that might just conclude today's session.
Yeah, sounds good. I think that's it.
Cool. All right, guys. Thank you once again for attending. Hope you guys found this session insightful. If you have any queries or concerns whatsoever, please feel free to reach out to us.
Thanks so much, Jono and Danny.
Thanks, guys.
Thank you. Cheers.
Take care.